Welcome students who are taking financial accounting, and in this series of videos we are going to be working on the assigned homework problems from chapter 8, the short exercises. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you do not understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. All right, so let's see here. Let me get my pen. And all right, so short exercises. 8-2. Long-term asset terms. All right, so for each of the following long-term assets, identify the type of expense that will be incurred to allocate the asset's cost as depreciation expense, debit. Depreciation expense, debit, depletion expense, okay, DL. All right, so yeah, depreciation expense is a debit. They're using DL for depletion expense. Amortization expense is an A, and none of these, which is not applicable. So it's not a debit, it's just DR. They're just using these as shortcuts. In reality, they're all debits. But anyway, because they're all expenses. All right, so for franchises, right, that is, maybe it's easiest to think of it like this. If it's a fixed asset, it's depreciation. And this was covered in the theory videos. If it's an intangible asset, it's amortization. And if it's a natural resource, it's depletion. Okay? And then, of course, none of these. So a franchise is not something you can touch, so it's an intangible asset. So that's amortization. Land is none of these, not applicable, because why? Land is not, you can't depreciate it, you can't deplete it. You got to deplete the natural resource in it, but you can't deplete the land itself, and it's not intangible. So land is not applicable as far as you can't depreciate it for usage. And remember, that's what amortization, depletion, and depreciation is. It's being able, even though you have this asset, the question is how do you record the usage, the wearing out of that particular asset? Well, land is land. It doesn't, you buy a piece of land, it doesn't, go away. It's not like, a good example is, say, a car. You buy a car and it's going to wear out over time. Sure, some cars last 40, 50 years, but the vast majority wear out, right? Well, that land is there. It's never going away, so you can't get rid of it. So it's not depreciable. Right, buildings, that is a fixed asset, so that's going to be depreciation. Same with furniture, that's depreciation. Patents are intangible, so it's amortization. Copyrights are intangible, so that's amortization. Trademarks are intangible, so that's amortization. Land improvements, okay? Now land improvements, remember, when you have the piece of land, things that you do to it in order to get it to be usable, like fences, sprinkler systems, things like that. There you think along the lines of, even though land isn't depreciable, the improvements are. Okay, and you can consider those as a fixed asset, so this would be depreciation expense. And gold ore deposits. Okay, so gold ore deposits are a natural resource, so that's depletion, DL. 8.3. Right. Identify each of the following as land or land improvements. Okay, so Survey fees would be land, right? Because that's a part of determining, the portion of your land in and of itself. It's not doing anything to the land. Fencing is a land improvement. Same with lighting, because you're putting it on the land. Clearing the land would be land. Okay, it's not a land improvement. It's clearing the land, is getting the land ready for usage, so it's part of the land. But putting a parking lot on it is a land improvement, right? Because the land is there, you put the parking lot on top of it. All right, 8-4, lump sum purchase. Peterson purchased land having a current market value of $110,000, a building with a market value of $88,000, and equipment with a market value of $22,000. Journalized the lump sum purchase of these three assets purchased for a total cost of $210,000 in exchange for a note payable. Okay. Okay, so I actually had to pause the video here for a second because when I glanced down at the solution in the solution manual, it looked odd to me, and so I took a look at it, and I will agree with the computations, okay, but I don't agree with the journal entry. The journal entry doesn't make any sense to me as far as the numbers that they used. So just be aware that if you're looking at the solution manual, I'm not going to agree with that journal entry. The computations, I will. Okay, so an explanation as to how to do this problem, right? Now remember, we have a current market value, so we have land with a current market value of 110,000, and then we have a building with a market value of 88,000, and equipment with a market value of 22,000. Okay, so that totals, let's see, 10, 10, 20, 220,000, okay, as the market value. Now, here's the thing. We're purchasing for the lump sum purchase for a total cost of 210,000 in exchange for a note payable. Okay, so my note payable is going to be 210,000, right? But now here's the gist. I mean, it's 210,000, but my market value is 220,000. So the way we think about this is we have to take and figure out the percentage of the 220,000 that each of these items are, okay? And whatever those percentages come out to be, then we apply it against the 210,000 in order to determine our the cost for our journal entry. Okay, so how do we figure out the percentage? Well, you take 110,000 and you divide it by the 220,000, right? You learn this in Math for Business and Finance. Very, very simple. I mean, here's the whole pie, right? This is 220,000, right? If we have three parts, and this is 110, and this is 88, and this is 22, right? What percentage of the 210,000 are each one of those? So we have 88,000 divided by 220, and we have 22,000 divided by 220. So let's see here and quickly doing the math. Okay, so 110 is half of 220, so that's 50%. 88 divided by 220 is 40%. Where's my pen? Right, 40%. And of course, the remainder has to be 10%, right? Because they all have to total 100%. So these are the percentages that we're going to apply against the 210,000 that we're using as a note payable. So 50% of 210,000 is 105,000. oops, not 105,000%, 105,000. All right, 40% of 210 ends up being 84,000, and the remainder, you can either multiply it out or add and subtract, ends up being 21,000 for the equipment. So that ends up totaling 210,000. Do the math to double check yourself. So these are the figures that we're going to use for our journal entry, right? So for our journal entry, we're going to debit land for 105. We're going to debit building for 84,000. We're going to debit equipment for 21,000, and we're going to credit our note payable for the $210,000. Okay, so that's the journal entry I would come up with for this particular problem, and not the solution that's in the solution manual. Okay, right. So if you go back and think about this, this isn't really not that difficult. It's just a lot of math. When you buy 3 assets, or you buy however many assets, and you know what the market value is, you figure out the percentage of each asset as part of the overall total market value, and whatever that percentage is, you apply it against what you pay in order to determine how to make that journal entry. Because the bottom line is that you're only going to pay, whoops, the other way, you're only going to pay a specific amount, and you're booking it based upon the amount you're paying, right? You're not booking it against the market value. I mean, that's that. I mean, there is, sure, they're making out $10,000, the difference between 220 and 210, but you're only paying the $210,000 in cash. Okay, so go back and watch this video again if you have to, and if you still don't understand something, feel free to either watch the theory videos or to contact an instructor either via email or a telephone call. Okay, and I'll see you in the next video for the next exercises.